Welcome to Cognitive Dose. We are here, as always, curing blind spots and shattering cognitive bias. Imagine a trader in October of 1929. The stock market is just in absolute freefall.
Right. Complete panic on the street.
Sheer panic. You have crowds gathering outside the exchanges, and, generational fortunes are just vaporizing by the minute. And yet, one man quietly walks out of his brokerage office, having short-sold the entire market, and he pockets over $100 million.
Which is, what, the equivalence of over $1.5 billion today?
Easily $1.5 billion. Yeah. That man was Jesse Livermore, and today we are turning our analytical lens onto a text that basically codified his life, a book that has maintained this, an almost mythological status in the financial world for over a century, which is Edwin Lefebvre's 1923 classic, Reminiscences of a Stock Operator.
Yeah. If you walk onto the trading floor of, a billionaire hedge fund manager, or even just look at the desk of a retail day trader, you will probably find a dog-eared copy of this exact book.
Absolutely. So our debate today centers on a very clear question. Is this text a foundational, timeless treatise on trading psychology and price action? Or, as we'll explore, is it a dangerously anachronistic manual that normalizes predatory behavior and practically guarantees financial ruin for the modern reader?
Exactly.
I'll be laying out the book's enduring frameworks, its brilliant observational mechanics, and I think its undeniable historical value.
And I will be taking the opposing view. Because look, while the narrative of the master speculator is undeniably elegant and, frankly, just a great piece of literature.
Oh, it's a fantastic read.
It is. But submitting it to scientific and empirical scrutiny reveals a deeply, deeply flawed framework. I'm going to argue today that the book's enduring popularity relies almost entirely on a massive survivorship bias, anecdotal fallacies, and the fact that it willfully ignores the sweeping transformations of algorithmic execution and modern securities law, not to mention the mathematical reality of human cognitive bias.
Okay, well, let's start by fairly and comprehensively explaining the appeal, right? The core concepts of this source material, because to critique it, we really have to understand why it has survived as the unofficial Bible of Wall Street for 100 years.
Fair enough. Lay out the framework.
Early 20th century, stock prices were printed sequentially on a physical paper ticker tape.
Right, literally just watching the ink print.
Exactly. And Livermore's core philosophy was that by intensely studying the chronological sequence of price and volume prints on that tape, a trader could intuitively discern what he called the line of least resistance in the market.
Essentially reading the literal physical momentum of the paper.
Yes, and he started operating in what were called bucket shops by age 15. Now, it's important to understand what a bucket shop actually was. You weren't actually buying underlying shares on a regulated exchange.
You were essentially making side bets with the house on where the price on the ticker tape would go.
Exactly, yeah. And the house actively wanted you to lose. But Livermore mastered the mechanics of speculation through just sheer observational discipline. He got so incredibly good at reading the tape that the bucket shops literally banned him from their premises.
He was like a card counter being thrown out of a casino.
That is exactly what it was like. And beyond the mechanics, the book is really a masterclass in human psychology. Livermore argued that a successful trader must completely reverse their natural biological impulses. He stated that it is inseparable from human nature to hope and to fear.
Right.
The amateur fears that a loss will grow bigger, and they hope that a profit will run further. Livermore said you have to flip that. You must fear that your profit will evaporate and hope that your winning streak continues. It is, honestly, an extraordinary intellectual framework for understanding momentum and self-discipline.
Well, it is an extraordinary piece of fiction when applied as a modern blueprint. Methodically introducing the deconstruction here, we have to look past the romance of the boy plunger beating the casinos.
Okay, let's hear it.
When we submit Livermore's methodologies to rigorous academic, quantitative, and structural examination, they decompose into completely anachronistic heuristics. We are looking at a protagonist whose strategies functioned as predatory wealth extraction mechanisms prior to the establishment of modern regulatory frameworks.
Predatory?
Yes. To treat this as a reproducible guide today is to ignore the realities of high-frequency trading and the empirically proven superiority of systematic algorithmic investing models.
So you're drawing a very hard line there? You're saying it's not just outdated, but actively predatory?
I am. And that is exactly where the deconstruction must begin. The text fundamentally glorifies pre-SEC fraud. To understand the structural chasm here, we have to define the historical role of a stock operator.
Okay, define it.
Modern readers mistakenly view Livermore as a pure directional trader. They picture, a lone genius in a room extracting alpha through superior fundamental or technical analysis, just outsmarting the crowd. But in reality, the climax of the book, and really the latter half of his career, centers on his employment as a paid manipulator hired by insider investment pools.
Wait, but he was providing liquidity. I mean, he was creating a market for highly illiquid shares that otherwise wouldn't have been able to trade at all.
He was engaging in textbook predatory manipulation. Let's break down how this actually worked mechanically during the Roaring '20s. Corporate insiders holding moribund, dead stock, say a failing railroad company, would form a syndicate and hire Livermore.
Right, they'd bring him in to move the paper.
Exactly. And he would engage in what are called wash sales. The street called it painting the tape. Livermore would control multiple affiliated accounts. He would have account A sell 10,000 shares to account B. A minute later, account B sells them right back to account A.
So he's just passing the exact same shares back and forth between his own hands.
Exactly. He's taking the shares out of his left pocket and putting them in his right pocket. But what does the public see? The physical ticker tape suddenly starts printing massive, rapid-fire volume for this dead railroad stock.
Ah, so they see momentum.
Right. Retail speculators sitting in brokerage offices across the country see this artificial momentum. They think, oh, something huge is happening. Insiders must know something. And they buy in with real capital. Once retail steps in, Livermore aggressively dumps the insiders' worthless shares onto the public at vastly inflated valuations.
And he takes a cut?
A massive cut. He would extract exorbitant 25% fees for himself, and the retail investors were left holding the bag as the stock collapsed. I mean, this isn't capital formation, it is parasitic wealth extraction.
Okay, I see exactly the mechanics you are describing. It's hard to defend the wash sales. But let me give you a different perspective on the historical context here.
Go ahead.
The SEC, the Securities and Exchange Commission, wasn't established until 1934. The Securities Exchange Act didn't exist when Livermore was building these syndicates. So isn't judging Livermore's 1920s strategies by modern fiduciary standards a bit like, I don't know, issuing a speeding ticket to a horse-drawn carriage?
A speeding ticket to, well, it's a clever analogy, but
it's true, right? He was operating optimally within the unregulated environment that existed at the time. You cannot retrospectively moralize the mechanics of a totally different era.
it's not about retrospective moralizing. It's about the structural damage that methodology causes to a financial ecosystem. But even if we address the historical argument, the data suggests the objections were highly contemporaneous. Let's unpack the hidden assumption there, which is that nobody in the 1920s knew this was harmful.
They didn't have laws against it.
They didn't have laws, but they had ethics. Edwin Lefebvre himself, the actual author of the book, published essays as early as 1904, noting the moral turpitude of these practices. Critical contemporaries viewed inside information as a snare used to hoodwink the public. Political cartoons at the time literally depicted pool operators as poisoning small investors.
Really? Poisoning them?
Literally. The problem with Reminiscences is that it frames the deception of the masses as a sophisticated art form requiring deep market knowledge. It rationalizes structural manipulation. And purely from a macroeconomic perspective, when markets are perceived as rigged games where insiders hold asymmetric advantages, public participation declines. When trust evaporates, liquidity dries up, and that actively harms genuine capital formation.
Okay, you're painting a picture of this purely mathematical, predatory machine.
But let's play devil's advocate and strip away the insider rings. Let's look purely at the guy sitting in his office just reading the tape. Doesn't the sheer physics of momentum still matter today? I mean, the tactical methodology of looking at price action and inferring where the market wants to go.
It doesn't. And I will methodically dismantle why manual tape reading is scientifically obsolete. We have to look at the physics of the market in the early 20th century versus today.
Which is mostly speed, right?
Speed, yes, but also human limitations. Back then, price discovery moved at the speed of telegraphic transmission. Trades were executed by human beings on a physical floor. So the prints on the tape reflected human reaction times, human order sizing, and human psychological exhaustion. Because it was human, it was biologically possible for another human to visually process that data and find a rhythm. Today, that is cognitively impossible.
Because of the raw speed of electronic execution.
The speed and the deception built into that speed, the introduction of electronic communication networks and the massive proliferation of high-frequency trading, or HFT, fundamentally altered the physics of the market. Liquidity is fragmented across dark pools and lit exchanges, executing in microseconds. The modern limit order book is completely saturated with statistical noise.
Walk us through what that noise actually looks like to a retail trader looking at a screen today.
Okay, imagine playing poker against an opponent who can flash $1 million chip stack to scare you into folding, but the millisecond you decide to fold, they pull the chips back off the table before you can even blink.
Oh, wow. So you're reacting to a ghost.
Exactly. That is what algorithmic trading does. It's called layered spoofing. Algorithms place thousands of buy orders a second, only to cancel 99% of them milliseconds later. They aren't trying to buy the stock. They are just probing the market depth to see how human traders react. Furthermore, they engage in latency arbitrage.
Which is the microwave tower thing, right?
Yes, an algorithm using microwave towers can see your order coming, buy the stock a microsecond before you do, and sell it to you for a fraction of a penny more. Attempting to apply Livermore's visual heuristics to a modern electronic limit order book is like trying to navigate a modern metropolis using a medieval map. Even legendary modern managers who started as tape readers in the 80s explicitly state that the tape is now entirely synthetic and far too fast for the human eye.
That makes sense for the microsecond tick data. But let's pull back from that and look at Livermore's broader frameworks, which intentionally abstract away from the raw speed of the tape. For instance, he famously advocated for the century mark rule.
Right, the psychological levels.
Yes. This is the idea that when a stock crosses a major psychological threshold, like $100 a share or $200 a share, it is destined for rapid momentum continuation, or his reliance on what he called pivotal points, where he would wait for very specific psychological price confirmations before entering a trade. Lefebvre famously asserts in the book that the game does not change, and neither does human nature. Algorithms might execute the trades, but ultimately, isn't the market still an aggregate of human fear and greed?
That sounds elegant in theory, but the data suggests otherwise. It is a very seductive narrative, but I just don't buy it. You are relying on what behavioral economists call the constant human nature fallacy. To shatter that assumption, we have to look at modern behavioral finance, specifically the work of psychologists Daniel Kahneman, Kahneman, and Amos Tversky.
Ah, prospect theory.
Exactly. In 1979, they published prospect theory, and prospect theory mathematically proves that the discretionary, emotion-driven risk-taking championed in this book is empirically inferior because it is bound by hardwired cognitive bias.
Wait, hold on. Doesn't prospect theory actually support Livermore? I mean, prospect theory formalized the exact hope and fear dynamic Livermore described. He recognized it, and he told traders they had to conquer it.
He told them to conquer it, but Kahneman, Connninman, and Tversky proved it to be a biological imperative. It is not a mere lapse in discipline that you can out-engineer with sheer willpower. They demonstrated that the human value function is deeply asymmetric.
Unpack that a bit. Asymmetric how?
To put it simply, the psychological pain you feel when you lose $1,000 registers in your brain roughly twice as intensely as the joy you feel when you make $1,000. It's concave for gains and convex for losses.
So we are biologically wired to be bad at trading.
Exactly. Because of this asymmetric pain response, when a discretionary human trader faces a loss, they become risk-seeking. They hold on to depreciating assets, praying for a reversion to the mean just to break even. But when they experience a gain, they become highly risk-averse. They liquidate their winning positions prematurely out of the fear of losing the profit.
Which is exactly what Livermore said amateurs do.
Yes, but Livermore believed a master speculator could just suppress these imperatives through sheer grit. Behavioral finance proves this is a biological fallacy for the vast majority of human beings. You can't just wish away your neurobiology.
Yes, but you cannot deny that the neurobiology of the individual retail trader remains susceptible to exactly those emotions. The market is made up of people.
The market used to be made up of people. The market itself is no longer a localized aggregate of human emotion. Modern liquidity is overwhelmingly provisioned by quantitative algorithms, passive index funds, and systematic market makers.
And they don't feel pain?
Right. A mathematical model does not feel hope. An index fund does not panic when the market drops. They execute based on statistical arbitrage, volatility clustering, and hard-coded parameters. And empirically, systematic investing is vastly superior to the human intuition Livermore preaches.
By systematic, you mean funds that don't rely on a human making a gut call?
Right. Systematic commodity trading advisors, funds that use logic gates to mandate value at risk, volatility targeting, and automated stop losses. They mathematically eliminate cognitive bias because a computer executes the stop loss without feeling the pain of the loss.
It just does the math.
It just does the math. And the empirical data bears this out entirely. Academic studies tracking hedge fund longevity reveal that systematic, rules-based funds boast an average operational lifespan of 12 years. Discretionary funds, those relying on Livermore's style of human intuition and subjective discipline, average only 8 years before succumbing to terminal drawdowns. Livermore's reliance on human intuition over systematic rules is scientifically proven to be an inferior methodology for long-term capital preservation.
That is heavy data. But frankly, you can't just dismiss his wins as statistical noise. If the math and the behavioral science are so conclusively against discretionary trading, how did Jesse Livermore achieve such legendary status? We cannot willfully ignore his undeniable historical outlier successes.
Oh, I'm not ignoring them.
I mean, he successfully predicted and took massive short positions during the 1906 San Francisco earthquake. He famously shorted the 1929 Wall Street crash, earning the title the Great Bear of Wall Street. Like I said at the top of the show, he made over $100 million in 1929. You don't make $1 billion modern dollars by accident. That is the application of a profound market framework.
It's an incredible story. It really is. But have you considered the massive survivorship bias inherent in that exact narrative? Proponents of this book endlessly recycle the anecdotes of his spectacular triumphs, but they completely ignore the statistical reality of his catastrophic failures. Jesse Livermore was not a paragon of consistent, disciplined capital accumulation. He was a highly leveraged gambler.
He operated with heavy margin, absolutely. But that was the norm for speculators of his caliber operating in the bucket shops and the early exchanges. Leverage was the tool of the trade.
But the leverage destroyed him repeatedly. He suffered total financial ruin and filed for bankruptcy multiple times, most notably in 1915 and again in 1934. And here is the critical point. Each of these bankruptcies was preceded by a direct violation of his own maxims.
He broke his own rules.
Constantly. He overtraded, he utilized excessive margin, and he succumbed to the exact emotional pressures of the market he claimed to have mastered. If his rules regarding pivotal points and risk management were robust and reproducible, his equity curve would have stabilized over time. Instead, his career was characterized by catastrophic volatility.
So you look at the $100 million win in 1929 and you see what? Just luck?
I see the false causality fallacy. In modern financial parlance, his legendary 1929 short was the equivalent of the O'Hare trade.
For our listeners who might not know, the O'Hare trade is an old Chicago futures pit colloquialism, right?
Exactly. The joke on the trading floor was that a speculator places a massively leveraged directional trade and immediately drives to O'Hare International Airport. If the trade works, they fly to a tropical island and retire a genius. If the trade fails, they flee the jurisdiction to escape their creditors.
That is quite the visual.
Right, but attributing Livermore's massive successes to his specific observational rules rather than to extreme mathematical variance and reckless leverage is a severe logical fallacy. Think of Nassim Nicholas Taleb and his work on black swans and survivorship bias. If you risk a massive percentage of your capital on a directional coin flip, a successive streak of correct guesses will yield a spectacular fortune. It will make you look like a prophet.
Because you're the one who survived the coin flips.
Exactly. But the laws of probability dictate that if you keep flipping that coin with maximum leverage, financial ruin approaches absolute certainty over an infinite timeline.
You're arguing that the mathematical inevitability of that leverage eventually caught up with him.
By the late 1930s, his discretionary edge was entirely extinguished. The SEC had been established, the rules had changed, and he was completely unable to adapt his intuitive methodologies to a newly regulated post-manipulation market environment.
Yeah, the game had changed.
It had. And in 1940, completely insolvent and with liabilities far exceeding his remaining assets, Jesse Livermore committed suicide in the cloakroom of the Sherry Netherland Hotel. He left behind a note declaring his life a failure. To sell his story today as a reproducible blueprint for retail traders relies entirely on false causality. His outlier successes were highly leveraged gambles in unregulated markets, not a sustainable, logical framework for capital allocation.
This brings us to a stark but necessary synthesis. We have to acknowledge that Reminiscences of a Stock Operator remains a fascinating historical document. I mean, as a work of financial literature, it masterfully articulates the profound psychological pressures inherent in speculation. It puts you right in the room with the ticker tape.
It definitely does that.
However, when we view it through the lens of modern market dynamics, it possesses unignorable, dangerous blind spots. The technical methodologies of tape reading have been completely nullified by algorithmic order flow and spoofing, and its reliance on discretionary risk-taking has been dismantled by the empirical realities of behavioral economics.
I'll leave the audience with this thought. Treating Livermore's romanticized story as a how-to guide for capital accumulation is effectively an instructional manual for financial suicide. It is dangerously masked by the survivor bias of a few highly publicized, highly leveraged historical anomalies. Clinging to its outdated maxims dooms modern traders to repeat the exact psychological and mathematical errors that destroyed the book's very protagonist.
And that is exactly why we analyze these foundational texts with such rigor. We advise you, our listeners, to use this analytical deconstruction to build your own mental immunity against romanticized financial narratives. Thank you for joining us on Cognitive Dose. Please remember to subscribe and keep questioning the frameworks you take for granted.